Hello everyone, and welcome back to our channel. Today, we're embarking on a journey to decode the mysteries of home equity lines of credit, commonly referred to as HELOCs. If you're a homeowner or you're dreaming of owning a home someday, knowing how to smartly use your home's equity could transform your financial landscape. We're about to explore the ins and outs of HELOCs, making them less daunting and more approachable. So fasten your seatbelts, folks. Let's get started. A home equity line of credit, often called a HELOC, is a type of loan where your home serves as collateral. Imagine it like this. Your home is a bank, and you're able to withdraw funds from it almost as if it were a credit card. Of course, this isn't free money. You're borrowing against the equity in your home, which is the difference between the market value of your property and the amount you still owe on your mortgage. Now, the mechanics of a HELOC are somewhat different from a traditional loan. Instead of receiving a lump sum, you're given a credit limit, much like a credit card. This limit is generally based on a percentage of your home's equity. You're then able to borrow up to that limit during what's known as the draw period. During this draw period, you can borrow as much or as little as you need, and you only pay interest on the amount you've borrowed. It's a flexible system that gives you a great deal of control over your borrowing. But what makes HELOCs particularly appealing is the freedom they offer. Unlike other loans, you're not restricted in how you use the money. Whether you need to finance home improvements, cover educational expenses, or consolidate high-interest debt, a HELOC can provide the funds you need. What makes HELOCs appealing is that you can draw from them as needed, up to a set limit. Getting a HELOC involves a few steps. It all begins with the appraisal of your home. This is a crucial step because the value of your home determines how much you can borrow. Once the appraisal is complete, the lender will then offer you a credit line based on this value, minus any outstanding mortgage balances. Now, here's where it gets interesting. Unlike a traditional loan where you receive a lump sum of money up front, a HELOC gives you the flexibility to draw funds as you need them. This period, aptly named the draw period, typically lasts for 5 to 10 years. During this time, you can borrow up to the limit set by the lender at your own pace. Think of it like a credit card. You have a limit, but you only draw funds when you need them. And just like a credit card, you only pay interest on what you actually borrow, not on the total credit line available to you. This can make a HELOC a cost-effective option if you're not sure how much money you'll need or when you'll need it. Now let's talk about repayments. During the draw period, you're usually only required to make interest payments on the amount you've borrowed. This means your monthly payments could be relatively low at this stage. However, once the draw period ends, the repayment period begins. This is when you start to pay back the principal along with the interest. The repayment period can last anywhere from 10 to 20 years, depending on your lender's terms. It's important to note that during the repayment period, your monthly payments will be higher as you're now paying back the principal as well as the interest. You'll need to be prepared for this change in your monthly expenses. In summary, a HELOC can be a flexible and convenient way to access funds when you need them. But it also requires careful planning to ensure that you can manage the repayments when the time comes. After this period ends, the repayment period begins, where you pay back the principal plus interest. One of the biggest advantages of a HELOC is flexibility. This type of credit line allows you to borrow only what you need when you need it. Instead of getting a lump sum at once, you can draw funds over a certain period, typically 5 to 10 years. This is especially beneficial if you're uncertain about the exact amount you'll need, such as for a home renovation project or for starting your own business. Another remarkable benefit is that with a HELOC, you only pay interest on what you've actually borrowed, not on the entire credit line. This can result in significant savings, particularly if you end up using less than your full credit limit. A HELOC can also be a great tool for debt consolidation. Instead of juggling multiple payments with varying interest rates, you can use a HELOC to pay off those debts. Then, you're left with just one payment to manage, often at a lower interest rate. It's also worth noting that HELOCs can potentially offer tax benefits. If you use the funds for home improvements that increase the value of your property, the interest you pay might be tax deductible. However, tax laws are complex and can change, so it's crucial to consult with a tax advisor to understand if this benefit applies to your situation. Moreover, a HELOC can serve as a safety net for unexpected expenses. Life is full of surprises, and having a line of credit you can tap into when needed can provide peace of mind. Finally, HELOCs often have lower interest rates than credit cards and personal loans, making them a cost-effective borrowing option. But remember, your home is the collateral, so it's essential to borrow responsibly. In conclusion, a HELOC offers flexibility, potential tax benefits, and can be a cost-effective way to borrow. It can be a powerful tool in your financial arsenal, helping you achieve your financial goals while making the most of your home's equity. Always check with your tax advisor to be sure. But there are risks. Yes, with all the advantages, home equity lines of credit come with their own set of challenges that need careful consideration. The most prominent among these is the variable interest rates. Unlike fixed interest rates that stay constant over the life of the loan, variable rates change based on market conditions. This could mean that your payments might increase over time, sometimes substantially. Imagine this. You've drawn a significant amount from your HELOC during a time when the interest rates are relatively low. Suddenly, the rates shoot up, and now you're left with a larger than expected repayment amount. Not an ideal situation, right? And here's the kicker. The stakes are high. Since your home is used as collateral for the loan, failure to keep up with the payments could mean losing your home. That's a grim picture to paint, but it's a reality that needs to be acknowledged. It's also worth noting that while HELOCs provide flexibility in terms of usage, this can also be a double-edged sword. It's easy to be tempted to use the funds for non-essential expenses or to treat it as a regular income source, which it's not. Remember, every dollar drawn is a dollar to be repaid plus interest. Another factor to consider is the potential for overborrowing. Since a HELOC allows you to borrow up to a certain limit, it can be tempting to borrow more than you actually need. This can lead to a debt trap where you're constantly borrowing and repaying, keeping you in a cycle of debt. And lastly, not all expenses financed through a HELOC may be tax deductible. While interest paid on funds used for home improvements can often be deducted, this isn't always the case. It's always best to consult with a tax advisor to understand the specifics. So it's crucial to consider whether you can handle potential rate increases and repay the borrowed money. Understanding the risks associated with a HELOC is as important as understanding its benefits. It's all about making informed decisions that suit your financial situation and goals. To decide if a HELOC is right for you, consider your financial stability, your long-term financial goals, and how disciplined you can be with the borrowed funds. A HELOC can be a powerful tool, but it requires a level of financial discipline. Remember, your home is at stake, so it's crucial to manage the borrowed money responsibly. The first factor to consider is your financial stability. Do you have a steady income that can comfortably accommodate potential changes in interest rates and the repayment of the borrowed money? If your income is irregular or you're anticipating significant changes in your financial situation, a HELOC might be a risky choice. Next, think about your long-term financial goals. Are you planning to retire soon, or do you foresee any large expenses in the future? If a HELOC fits into your financial plan without jeopardizing your future security, it might be a good option. Lastly, consider your discipline with money. Will you use the funds wisely and avoid unnecessary debt? The temptation to use your home's equity for non-essential expenses can be strong. If you're disciplined and have a clear plan for the use of the funds, a HELOC can be a beneficial financial tool. Deciding whether to take on a HELOC is a significant decision that will impact your financial future. It's important to carefully weigh the pros and cons. Remember, every financial situation is unique, so what works for others may not necessarily work for you. Always consult with a financial advisor before making such a big decision. Thanks for watching. If this guide has enlightened you about home equity lines of credit, show us some love by hitting the like button. Don't forget to subscribe and share this video with anyone who might find it useful. We're always eager to hear your thoughts and answer your questions. Do you have any queries about HELOCs? Feel free to drop them in the comments section. We're here to help. Until our next insightful video, take care and see you next time.